way that we're looking at this right now is that particularly the first year of the expansion is when you want to be long. And when we're talking about rate of change terms, which is a big theme around here, this is exactly what we're talking about, because the comp is essentially this very, very poorly monetized ad-supported model that has no leverage, that is essentially a cash drain. And then you're moving into more of a subscription product that is, one, monetizes at a much, much higher rate, and two, is literally contractually profitable, right? Because of the way that they've structured the deals with the labels and the way that they structure the deals with both Google and Apple. There's a contracted margin in there, in a sense, right? So,
what's your take on like the investment community's understanding of this comp effect?
So I don't think that, I think that the investment community is, I think there's two things. I think that what happened off the last print is, I think, actually, let me take a step back there. I think the investment community is playing the 2015 trade, and they're basically saying, oh, this model's never going to work, they're never going to achieve any leverage, they got screwed by Web 4, and this thing's just a dead story. Like that was 2015's trade, right? And as we're looking at the 2017, by the way, so we just went long, I think maybe a month or two ago, I can't remember, but we're getting in front of this expansion, this migration. This is what we're playing. Because what essentially is going to happen is that 2015 trade that a lot of the investment community is late to and is playing right now, Pandora is essentially going to kill that as we're moving into 2017, right? Because we're going to get it's going to be much, well, actually, taking another step back, what we're going to see next year is we are going to see accelerating revenue growth simply because they're going to be migrating more of those ad-supported users into a subscription product, and they're making a point to do so. And we're probably going to see at the same time increased operating profit, not necessarily margins, but profit, right? And it's because of that ARPU differential. So, you know, I think that what's going on right now is people are late to that trade, and I think the other problem is, and where we're particularly frustrated, is that this management team has done a very, very terrible job managing expectations, right? So they missed on the ad-supported side hard last quarter, but they just cut their guidance the quarter before that, right? So, okay, if you're gonna cut your guidance, if you're forced to cut your guidance, cut it.
Yeah, cut it. Yeah, exactly.
Just
cut it. Set
right?
a low bar.
Right, like set a low enough bar so you can
don't cut it and then miss.
Yeah, and that's the thing is the buy side is particularly frustrated because they're walking in because they can't trust this management team, right? And they're starting, anecdotally from what I'm hearing, they're starting to get behind the activist camp and basically saying we don't trust these guys sell, which is another reason why we're here, right? Because I think that blowing up your holder base 2 quarters in a row on poorly managed expectations is basically unexcusable, right? I think.
Well, it depends. Some people would say, well, that's not really the management's decision. Like that's not their job to.
Sure, I don't know. It totally is because we have to. Expectations are set by management. Sell side anchors their estimates off of whatever management tells them to do, right, through their guidance. So. By not actually lowering your estimates enough into the 4th quarter, or when you cut your guidance on the 2Q print, you should have given yourself enough wiggle room. That's kind of what the pressure on the stock is today, right? That and not really understanding the new cost structure moving into 2017 and the actual subscription opportunity in front of them. But this management team has shot themselves in the foot a bunch of times by not managing expectations. But anyway, so you know, as we look out to next year, we gained a lot more comfort around the story, and I think the main reason is one, management basically told us that the subscription opportunity is now the priority, and some evidence behind that is that one, they're going to forfeit some of their own ad inventory to use to actually promote the subscription product. So they're going to use their own ad inventory that they normally sell, and they're actually going to use that to start pushing the subscription product to existing users.
Yeah.
The second thing is, and this is actually the big one, is that they put a listener cap back on, and it's not the same 40-hour cap that we had before, but Josie, if you can you go to the third and fourth chart that I sent you, or maybe it's 4 and 5, I can't remember. One more down. There we go. All right, so just for some historical context here, this is what happened the last time that Pandora put a cap back in. And basically what they're doing is they're saying, within any given month, you can only listen to 40 hours of music for free, right, on the ad-supported side,
yeah.
but then we have to cut you off, right? What happened the last time they did that is they got this huge surge in new subscriptions, basically because they pushed the user into it. They're doing that again, not so much as aggressively as this one that we had, which only lasted for 5 months. But Josie, if you go to the slide, I believe after that one, this is what happened in that 5-month period where they put the cap at. When they would put the cap on, they literally doubled, or almost doubled, their subscription conversion rate in a matter of 5 months, yeah. Right? So that's the thing, is that I think a lot of people have been trained to believe that there isn't a subscription opportunity, that, oh, no one's ever going to pay for music. Everyone is just accustomed to paying for free music, and that's just the way the world works. Mm. Josie, can you go to the third slide? Perfect. So we ran a small survey, just basically saying this is what the new Pandora subscription product is, right? So instead of just ad-free, unlimited skips, unlimited track replays, and you can listen offline, same price. And we said, is there any interest here?
Yeah.
Right? Roughly 40% of our respondents basically said, it's like, yeah, I'm actually interested, right? That's a huge number, right? Because if you go, Josie, to the very, very first slide, this is what this means in terms of what the opportunity looks like. Mm. And this is basically a scenario analysis that we're running saying, what does the subscription opportunity mean for 2017 growth, assuming no revenue, no ad-supported revenue growth next year, and assuming that every one of those users who ports into a subscription opportunity, whatever money that Pandora was generating on them from the ad-supported side is just completely lost.
Yeah.
So in a sense, we're assuming down ad-supported revenues in this slide. And basically the whole point is, the reason why this works is that because of that ARPU differential, is that going from $1 a month to $5 a month, or even $10 a month,
yeah. Right?
And the whole point is Pandora doesn't need a ton of conversion to actually drive a considerable amount of revenue growth next year. Now, going back to what I was saying before, where we said 40% may be interested, if you just take a look at these conversion rates here, we're talking about 10% conversion rates could lead to double-digit revenue growth, massive acceleration.
Yeah. Wow.
Right. So that's the thing, is that we're not kind of blindly going into this and saying, oh, we really love this subscription thing and everybody's going to sign up for Pandora Plus or the new Pandora, I think it's called Premium, which is the interactive product, e.g. Spotify. We're saying they really don't need a lot to make this work.
Yeah.
Now, when we think about a stock that's essentially been left for dead, right, that had traded in the high 20s as early, or the mid to, call it low to mid 20s, as recently as last year, Pandora can really breathe life into this story by just showing some progress here on the subscription side, right? So the reason why we're in this is that we got in this with a longer time horizon than we normally would, right? So we said we're going to be in this through 2017, right? And it's going to be bumpy along the way, as we just saw in this most recent print and analyst day. But we're not just playing for like a 10, 15, 20% move. We're playing for a double, right? So that's the thing, is that this thing is going to be rocky, but you know, the way we're looking at it is that if you have a long enough holding period on this, this is going to work.
Sure.
And this is going to work big.
Yeah.
And in like a very short period of time. So you know, that's kind of it. So you know, at like $10 a month, I mean, if I were allowed to buy this in my PA, it'd be loading up right now.
Hey, that's good. Put it on the line. Good stuff.
Yeah, so I mean, that's essentially it. Is that you have you know, Pandora is essentially the red-headed stepchild in internet land right now. You know, I think that the stock's really been left for dead, and I think that people are over-anchoring themselves on the, you know, 2015 trade that's already played out.
Yeah.
You know, now it's kind of essentially the future trajectory of the business, and that looks much, much better, largely because the comp is that, you know, crappy ad-supported business that is going to make this subscription opportunity look really, really good.